Hello, fellow Rebel Capitalists. Hope you're well. So we have new inflation data that shocks the market. In fact, the inflation data is higher, or just as high, or the highest point, I should say, in the last 3.5 years. So we had the CPI yesterday, and that kind of was understated, or that was, let's say, anticlimactic. It came in just beneath market expectations. But the PPI was out today, the producer price index, and that blew away expectations, which has a lot of people screaming stagflation, stagflation, stagflation. And a lot of market pundits, let's say, are saying, all right, here's when the tariffs really start to hit the U.S. economy. And they're hitting the producers hard now, and they're likely going to hit the consumers, very, very soon. So let's dive into the data and see what on earth is going on. Let's try to make some sense of this and connect some dots to see if we should really start worrying about stagflation. And when I'm talking about stagflation, I'm talking about an acceleration of inflation, not just a price adjustment due to, let's say, 25% tariff on Toyotas being imported from Japan or something. Okay, let's get into it. Josh, do you know who Ric Flair is? Josh is failing. Josh is on Tinder. See, this is why Josh will never have his own channel. Or he's got his own channel, but he'll never have 100,000 subs. Because to be the man, you got to beat the man, Josh. You're never going to beat this man.
I have no
right
clue
here.
who Ric Flair is.
Spend too much time on Twitter or on Tinder. You don't have he's the Rolex wearing, private jet flying, wheeling dealing, kiss stealing, son of a gun, and he can't help but keep these alligators down. How'd I do there, guys? How'd I do? Okay, enough of that stuff. Woo! Exactly. All right, let's get into the data. I'm the Ric Flair of macroeconomics. I am the man. And Josh is never going to beat the man. Okay, so we look at the PPI. Now, expectations were for 0.2%. And last month it was 0. And so this month, just the change from June, because these would be the July numbers, 0.9. 0.9. Like I said at the beginning, this is the highest reading we've had in like 3.5 years. And then we've got core PPI, which, let's see here, was expected at 0.3. Last month at 0. We had a 0.6. PPI year over year last month, 2.3. This month, it jumps to 3.3. And core year over year goes from 2.5 to 2.8. This is really big news, guys, on a lot of different levels. Let's go right into this article from MarketWatch. I'm going to try to zoom in so we can see this a little bit better. Okay, there we go. So according to MarketWatch, and so, mainstream media, we kind of want to listen to what they say, but take it with a grain of salt. The clearest sign yet, tariff inflation is hitting companies. Wholesale prices jumped the most in 3 years. Surprising increase in producer price index intensifies focus on debate whether or not the Fed will cut rates. And I don't want to get off topic here, but should this impact the Fed's decision? I don't think so. Because even if this is passed through to consumers, which it very well may be, it's not going to result in an increase, an acceleration of inflation. That's what we got to worry about. Where the CPI, or whatever proxy you want to use, goes from 3% to 5% to 6% to 9%, straight up. That's what the Fed should be worried about and paying attention to. If we just have a price adjustment, number one, it is what it is. There's nothing you can do about it. And number two, there's nothing that you can do about it, but there's definitely nothing the Fed can do about it. Because so what? They keep they keep interest rates at 4.3, the overnight rate. And Does that somehow is that somehow going to stop the price adjustment? No, because the price adjustment's from the tariff, from the increased tax. So the Fed can't do anything about this. I don't think this should reprioritize inflation over the unemployment or the labor market in terms of how the Fed sees the economy. Now, maybe I'm not saying that this isn't a big deal, but I'm saying that if you're just looking at this through the Fed's framework and their mandate, I think the risks are still on the side of the labor market, especially when you consider there's nothing they can do about this. They could take the interest rates up to 5. They could hike interest rates by whatever, 75 basis points. And is that going to somehow impact the prices of the stuff coming in from China due to the tariffs? No. It is what it is, right? Okay, let's keep going. So, like they said, PPI up 0.9%. We're starting to see the inflationary pressures bubbling. We're starting to see the price adjustment pass through. I think the devil's in the details here. So then they're just restating the numbers we just went over. Oh, what is interesting, let's go over to the BLS. So let's zoom in again. What I wanted to point out is the goods PPI versus the services PPI. So right here, I hope you guys can see this. We've got the services up 1.1%. The price of goods up 0.7. So is this a result of tariffs? I mean, I don't know. I mean, I don't know how you could argue that the 1.1% increase in services is due to tariffs. Like maybe they're just, I don't know. Maybe it's all in goods and they're trying to somehow finagle keep the price of goods down, services go. I don't know. I would really need to think this through, and I'd love to interview a few people that are in this type of supply chain to understand exactly what's happening in the trenches. But I don't know that I would agree with this Market Watch article that where you can just immediately assume this 0.9 is completely due to tariffs. Now, you could say, George, it's due to money printing. I wouldn't agree with that either, and I'll show you why. Let's go over to M2 Money Supply, and we're flat, guys. So has it increased lately? Sure, but it's at the same trend that we saw when the CPI was extremely low. And remember, back here, not that you believe the government's numbers, but you can use it as a proxy for the trend. Back here, the Fed was fighting deflation. Remember that? We got to get inflation up to the 2% target because, oh, woe is me. We can't allow prices to actually go down. We can't give the consumer a break. So we got to get prices up to 2%, up to 2%, up to 2%. And remember, they couldn't do it. They couldn't do it. They needed the cerveza sickness, the supply shock, and the stimmies in order to get the inflation up. And then, of course, it went higher and higher and higher. It went way past their 2% target. But the point is, they couldn't even get inflation measured by the CPI past or up to 2% with this level of M2 growth. And even if you go back to, let's say, the end of 2023 and just exclusively look at this trend, it's pretty much the same as we had during the 2010s. But if you look at it just going back to its high point, we're not even there. We're let's see the high point. Well, we're almost there. I guess we would be basically flat. I'm just trying to eyeball it here. But this, to me, would not explain. It's just not enough of a spike in the money supply to explain just this huge miss. And I mean, if you annualize that, for heaven's sakes, that's almost what, 10%, 11% annualized, a 0.9 month over month number. To me, the money supply, that doesn't explain it. Doesn't explain it. And by the way, the Fed is doing QT. Not that I think the Fed has any control really over the money supply at all. But even if that's your argument, the Fed's doing QT. I can pull up that chart real quick here. There you go. So the size of their balance sheet is decreasing. M2 is flat, basically, since its high point in 2022. And I don't know if you can say that this is due to tariffs, maybe goods, but the 1.1 in services, quite frankly, I don't know where that's coming from. You got me. I'm going to be honest with you. I'm not even going to venture a guess because that's all it would be. It's just simply a guess. But what's really interesting is when we look at the PPI, the producer prices, which is basically wholesale prices relative to the prices that people are actually paying at the retailers, the consumer. And if you guys didn't watch my video, the punchline here is month over month, that's only 0.2, which year over year, I think it was 2.7, which was pretty much in line with expectations. And if we just continue on that, at that 0.2%, at that 2% line, then, I mean, annualize that. Now we've got, 2.4%, something like that, if you annualize it. And then if you include these base effects, then it takes it down to 2. So there is basically they're going opposite directions. You got the CPI that's this, if not this, with base effects. And then you've got the PPI, which was this, and now it just goes straight up. And I don't think you can blame the whole thing on tariffs. Maybe a little bit. You definitely can't blame it on quote unquote money printing. Can't blame it on the Fed's balance sheet. Maybe velocity? I don't know. But velocity would imply that nominal GDP is really skyrocketing. And I don't know, guys. You live in the States. Do you see an economic boom out there every single time that you go to the grocery store or you go to Target or Walmart? Are all your friends and family members telling you about how easy it is to get a really high-paying job? And is your purchasing power increasing? My guess is it's probably doing the opposite. Another thing that could, I think, some food for thought, let's say, is this chart. So if we were seeing a big, let's say, jump, if the producers, now, let me be clear. I want to differentiate between the producers in the United States, that's applicable to PPI, and then the producers outside of the United States that are exporting goods to the United States. So they're exporting goods to the United States. That would be import prices because we are importing them. And Lynn, my good friend Lynn Alden, just tweeted this chart, which shows are the Chinese, are the Japanese, are basically all these countries that Trump has tariffed, are they paying the tax? Are they paying the tariffs? Because that's the narrative that you hear from the administration. I can't see it. Because if the importers are paying the tax, then the prices you would likely, or if they actually, I'm sorry, it looks like they might be absorbing. Let me think this through here. I might have got this wrong, guys. Excuse me. If import prices are not going up, then yes, then you could see this being absorbed by the actual exporters. So this could be why you're seeing CPI low, but it wouldn't explain the PPI. We still have that big question mark as to how the hell we go from an expectation of 0.2 or whatever it was. Last month, 0.0, just flat. And then this month, 0.9. So this chart just makes it basically even more confusing, as you can tell by me going over it live here. Let's go over to the Wall Street Journal. And this would lead me to believe that part of the tax, because someone's paying the tax. Like, you've got three options. Either it's the people selling stuff in the United States that have to import it. Either it's the consumer in the United States, or it's people producing the stuff in China. Let's just use that as a proxy. Those are the only three people that can pay the tax. And someone's paying it, right? Because Trump is out there touting how they're making $30 billion a month, whatever, from these tariffs. So Those are your three options. Based on this chart that Lynn showed, it doesn't really look like the Chinese are paying it, or excuse me, it doesn't look like the importers are paying it. But here, it looks like they are. Caterpillar projects up to $1.5 billion in tariff costs this year. So that means that they are taking the hit. So they're having to import all this stuff. They're paying a higher price. It's not showing up in this chart for some reason. But they're saying that they are the ones that are basically absorbing this cost. So they're paying the tax at the port for the stuff they need as an input to the tractors, let's say, that they're making. And instead of passing that cost on to the consumer, they're eating it. They're eating it with their margin. So in this case, if you believe what they say, the Chinese or the Japanese or the Malaysians or whomever isn't paying the tax, it would be the U.S. corporation is paying the tax. Now, another thing is they could have their factories outside of the United States. Let's go into this. Manufacture, that could be another thing, that they're manufacturing outside the United States. So when they import what they manufacture outside, even though it's a U.S. company, they're having to pay the tariff. See, operating income fell. Yes, we've got that. And okay, so this isn't even an article, it's just bullet points. The manufacturer anticipates 400 million to 500 million tariff costs this quarter. Operating income fell by 18%, largely due to higher manufacturing expenses attributed to tariffs. Let's see if we can click on this. Oh, yeah. Okay, so it is from the components likely that they are importing, even though the manufacturing plant is here in the United States. So the bottom line, guys, is first of all, huge inflation numbers. We've got to pay attention to that. Do I think that that will lead to an acceleration of consumer prices? No. Do I think that this could be passed through to the consumer as far as a price adjustment? Yes, absolutely. Do I think the Fed should pay any attention to that? No, because they can't do anything about it. And the labor market, as we know, is deteriorating quite rapidly. So who is actually paying the tax? I have absolutely no idea. I really don't. And I think that anyone that says they do know is just feeding you a line of BS. I don't think we're going to have to wait for a few more months and just try to parse through the data, all the data points that I went over, see how the PPI plays out, see how the CPI plays out, and then look at this chart that Lynn posted, along with the anecdotal evidence that we're seeing in the mainstream media on a corporation to corporation basis to determine what exactly is happening. And why is that important? Why is it important who's paying the tax? Because that could have a huge impact on the overall U.S. economy, not just on corporate profits, but if it is passed through to the consumer, then I believe that would accelerate an inflation, or excuse me, accelerate a recession if that's where we're headed. It would make the labor market worse because people would have to pay, they'd have to rob Peter to pay Paul. They'd have to pay the stuff that they need where the prices are going up. And then that would take purchasing power away, aggregate demand from those domestic services or discretionary. And then that increases the unemployment rate. And then you get the demand destruction on the other stuff with the items that you need. Very similar to what we saw in the GFC when the CPI went from 3.4 in 2007 all the way up to 5.6 in July of 2008. And then we know how that story ended. We had massive disinflation. 2 months later, the Fed was at zero. And I think within 6 months, we had actual deflation, not just disinflation in Q1 or Q2 of 2009. So I was not expecting this as far as a 0.9 number. That shocked me. That shocked the market. That puts the Fed, I guess, from a narrative standpoint, in a very difficult position. I think it also puts the Trump administration in a difficult position because although I agree with them that interest rates should be lower, how do you argue that to the general public or the market when you have a PPI number like this? Drama, drama, drama. That's for sure. All right, guys, enjoy the rest of your evening. As always, make sure you are standing up for freedom, liberty, free market capitalism. Remember, if you want to be the man, you got to beat the man. We'll see you on the next video.